us off. From my perspective, one of the biggest things about DeFi yield farming, DeFi rates, et cetera, is a lot of people are very tied into some of these crazy APYs. I mean, especially like from the time perspective as well. Obviously, a lot of these protocols try to bootstrap TVL metrics. They try to kind of like incentivize early, users of the protocols, et cetera, et cetera. And what you kind of see here is a lot of anchoring on some of these, crazy yields, crazy APYs. To say that we're constrained by, money markets and things like that, I do think that a lot of yield that is coming from DeFi right now in terms of, MEV rewards or trading volume and trading fees, natural organic yields that, come from those trading activities, I think that that's definitely sustainable. But yeah, that's just something that I'd kind of want to highlight there, especially early on.
So I want to say from a protocol perspective, trying to get to like a sustainable level of a very balanced emission and revenue is the desired state. But most of the time, I think it takes quite a while for protocols to achieve that state. I don't believe too many protocols are able to have attained that yet, but there are protocols like Hyperliquid, Uniswap. The revenue that they've earned far exceed the emission that they're offering. So, like from a protocol perspective, I think there are largely two things to consider when it comes to emission adjustments. Firstly, I think it's a lot of timing involved. Like if you pull the trigger too early, maybe you might shortchange yourself from further growth. Or if you extend it for too long, then you're stretching out your emission. And it might mean that you are not incentivizing activity enough for you to generate the revenue to be sustainable quickly. And then the other one is more on the quantum. So the more tokens you emit, the higher the sell pressure. And then that defeats the purpose of emitting tokens. If you emit too little, then you aren't able to incentivize activity. No one's getting interested in the product. So that's not that beneficial as well. But from a protocol perspective, I think these are the two main important considerations when it comes to emission. But the objective has always been to become sustainable. And we've seen cases of that. It's just that maybe as of now, it's still somewhat of a rare case.
I mean, we're in a position where we are bootstrapping TVL right now. So this is a real world case study for us. So we believe by using it, and this addresses, I think, both parts of the question. So right now, in the ETH world, sort of base staking rate is something like 3%. With some of the sort of the turbo products, like an Ether5 Vault, that goes up to like 5%. We think by being really clever in DeFi deployment, we can enhance that to about 10%. But in order to make that interesting for someone to actually give us the funds to prove that, we're going to have to do better than that at first. We're going to have to allow them to speculate on our project. We're going to have to guarantee 10%. And the only way we can do that is through our own token, right? It's not like we have anything else. And that's the incentive. But on the other hand, so what we need to do, the way we think about this is we're running a 6-month TVL bootstrapping campaign where we are going to guarantee 10% yield, right? On the basis that we can get 5 and we think we can get the other 5, but at first we can probably get like another 3 and we'll have to give the other 2. So we have to get to 10% without incentives in 6 months. That's what we have to do. And so what we're doing to sort of try and limit that is we said, we're going to limit TVL to 250 million, right? The reason why we're going to do that is it limits the emissions. Even if we have to provide all of it, which we won't, right? It's finite. But the race is, can we get to the organic level of yield we need to before the incentives run out? In the same way, by the way, like for any crypto project, you need to grow your revenues faster than your unlock schedule, or your token will go down.
I guess the next question is really about protocols versus funds. So on one hand, protocols increasingly offer sophisticated yield products directly to users, potentially disintermediating traditional fund structures. On the other hand, funds provide risk management, compliance, and expertise that individual users cannot replicate. So in your opinion, where does the equilibrium settle between direct protocol access versus professional fund intermediation?
Yeah, I'd like to, from our perspective at Ergonia, so we're some of the people who are kind of actively using a lot of these different DeFi protocols. We're running vaults, we're running strategies, et cetera, et cetera. So from our perspective, like things that are relatively simple, whether it is, a delta neutral basis trade, or the yield is coming from an option strategy, or it is something like relatively simple in terms of lending and borrowing, I feel like those will always be protocol owned. In terms of kind of like, the additional leverage up or the looping and things like that could also potentially be protocol owned as well. But in terms of kind of like sophistication and being able to actively deploy across, starting to get very, very complex with the daisy chaining of risk and different strategies and things like that, I think that will always be owned by a fund. You see a lot of this activity as well in terms of like how quickly people, on the fund side are able to kind of like, switch up their strategies. Fact of the matter is, like, DeFi moves very quickly. There are always, exploits and hacks and just, crazy things that go on in DeFi, and being able to be like someone, who is actively on chain, actively looking at wallets, actively like monitoring governance proposals, things like that, things that actually impact yields, tokens, prices, et cetera, et cetera. I feel like any yield strategy that comes from that will probably end up being managed by a fund. So in terms of kind of like where I think this ends up from an equilibrium state, things that are relatively simplistic, things that you can kind of do, at the protocol level, I think that'll always be owned by the protocol, of course. But once you start getting into, doing some of these more esoteric and exotic strategies, like, going back and forth between all these different protocols, borrowing, lending, things like that, I think that'll be owned by a fund.
Yeah, I largely agree. I think it's maybe not so clear of a boundary anymore. I think it's really converging. We've seen funds operating a vault or a pool on chain, and then the money just gets utilized maybe off chain to generate more money, and then distributed on chain to users. So I think there's some evolution here, and the lines are not so clear anymore.
Yeah, I think so too. Like, we think that the approach that we're taking is to put AIs as curators in vaults. So a vault sort of works like an ETF, right? You deposit in, you get a receipt, you can redeem it at some future date. So I think there is this idea that the infrastructure is starting to move on chain, and the definition of what is a fund is changing.
The next question is really about DeFi's composability and whether it's a double-edged sword or not. So DeFi composability allows protocols to offer complex yield strategies by combining multiple protocols, but at the same time, it creates interdependency risks and potential cascade failure. Are increasingly complex yield products creating systematic fragility, or is this the natural evolution towards a more efficient capital markets on chain?
I think Chen should take this one first.
Jeremy can start. Yeah.
Oh, well, this is kind of what Pendle does, but I think composability is one of the key benefits in DeFi, right? I mean, it allows money Lego blocks to be locked together. Now, clearly, if you don't know what you're doing and you open a 50x levered position and the market goes against you, you're gonna lose money. But that's got nothing to do with it being on chain, other than on chain is more permissionless, and inside of a bank, you're going to have a lot harder time opening that position. But the fact that it is composable is what allows you to build these complex structured products that would be otherwise unavailable. So one of the strategies that we run, similar to you guys, is we LP. But when we LP, we hedge the impermanent loss on in a perp on Hyperliquid, right? So how would you do that if you weren't on chain in TradFi? Like, that would be something that would require a lot of collateral, a lot of licenses, a bunch of relationships, etc. So composability in DeFi is what gives rise to the innovation. The ability to put things together in dumb or risky combinations means that occasionally people get wrecked.
Yeah, I also agree with the view. I think with respect to composability is really one of the main propositions of DeFi. And Pendle is a second order derivative. We can only exist when there are yield bearing assets. But also, from my observation, I think there is a limit to how many layers of derivatives you construct, because every layer that you add to an underlying, the risk factor increases quite substantially. Yeah. So like for example, if someone were to build on top of Pendle, the underlying is like say Pendle's PT token, and then PT token has another underlying in maybe another yield bearing asset. So like every layer of derivative involved is definitely an added layer of risk consideration. So the premium for risk has to increase quite substantially as well, and it's not linear. But I think it probably stops somewhere in the second order or third order of derivative. Beyond that, you really need a very, very high APY in order to justify any form of activities. So yeah, that's just an observation that I have.
Yeah, and then thinking about it from the risk perspective as well, it's super interesting. If you go back to the analogs to TradFi, maybe in 2008 with like CDOs squared and stuff like that, risk and TradFi, like those products definitely obfuscated a lot of the risk. The interesting thing about DeFi and composability is like you can actually see the code, you can see the smart contracts, you can audit everything, but whenever you start daisy training some of this risk, like a lot of the risk actually lies in the edge cases that nobody's running simulations on, nobody's kind of thinking about, and things that just happen out of the blue. And so thinking about it from risk, like analogs and how we think about, composability and daisy chaining risk, like Tian said, like you really need to have a massive increase in some of the yield and opportunities that you're getting for us to kind of start thinking about, anything beyond like the second order derivatives for DeFi yield. Yeah.
But I think in general, like everyone on this panel would say the composability benefits probably outweigh the risks. It just needs to be carefully managed.
Yeah. Sure.
So the next question is actually about cross-chain yield arbitrage. Yield opportunities exist across multiple blockchains, but moving capital between chains often introduces bridge risk and timing delays. So how do you guys optimize for yield across ecosystems without concentrating risk in cross-chain infrastructure that hasn't been stress tested?
Yes. So we actually do this. And so in terms of kind of like how we like to think about it is through separate allocations and portfolios of capital, separating the different L1s and the verticals that way. And so like a lot of the stuff that we do on DeFi and how we think about yield, first of all, a massive amount of our activity is actually on-chain trading. Yield is kind of like a secondary strategy for us. And so whenever we start to think about risk and bridging and things like that, the first thing that comes to mind is like, what is the opportunity here? We're obviously running like a lot of HFT strategies, SexDex ARB, DexDex ARB, delta neutral stuff as well. And so for us, like the first thing that comes to mind is what is the yield? Second of all, we like to think about it from the timing perspective. Like, is this a strategy or is this, a bootstrapping TVL deal and things like that? Is this going to be a 3 to 6 month commitment of our capital? Or is this going to be like, okay, we're in and out, we see 100% APY, this is only going to be here for a couple of weeks, like, et cetera, et cetera. And so from our perspective and how we think about the risk is it really is like comparing it to our existing opportunities on the HFT side, as well as kind of like the active on-chain trading. But in terms of like actually thinking about risk, we separate it into verticals. So it's not necessarily like optimizing cross-chain, but optimizing on each chain that we're active on. So it's not necessarily like, okay, we would love to just rotate our capital in and out of these opportunities. It's if we are taking an opportunity on chain, we want to maximize the opportunity we're given on that specific L1. That way we don't have to go back and forth between chains a million different times.
Yeah, it really boils down to risk management, because there could be an arbitrage opportunity somewhere else in another ecosystem, and then it boils down to the opportunity here, and then can it accommodate the size that you want? Yeah. Most of the time, I think the opportunities in other ecosystems aren't that. I mean, they could be attractive, but it can't really accommodate size. Like if you want to deposit $1 million or $2 million, maybe the premium declines substantially, and then it really does not warrant any kind of activity. You're better off just staying with Ethereum, where all the infrastructure is already very lindy, and you probably are very comfortable with all these instruments already.
But even within ETH, you still have fragmented liquidity across the L2s and what have you. And I guess the other thing that's happening is the infrastructure is changing as we speak, right? So the promise of based rollups and ZK proofs and the ability to be confident that the money's there even before it's finalized because you have a ZK proof that it's already been sent, right? Like so these problems are getting solved. What's interesting is these problems are getting solved at both ends of the stack, right? So you have a bunch of people in the infrastructure world, like look at what Justin Drake's trying to do, look at what Succinct's trying to do, look at what actually Puffer's trying to do on some of their stuff as well, right? There are people trying to solve this question of how do you make it all look like one chain, at least in the ETH world. Let's not get into like the other bits from the infrastructure layer. And then you have people looking at it from the other end, which is how do we do this as a curator? How do we do this within a vault? How do we risk manage this? How do we bridge, right? And the two are going to converge, because at the end of the day, this is a question of liquidity. It's a question of the availability of liquidity, the risk of deploying it, how fast it can be moved, right? And the other point is, if you're always chasing it, the reality is like, as the denominator goes, the yield reduces, right? Like that's just the math of DeFi. And so our view on this is that alpha is temporal, particularly in DeFi. And so if you're not there and lined up, it's pretty hard to get it.
Yeah, I think the next question ties pretty good into your last comment, which is, as institutional capital enters DeFi yield markets, we might see yield compression similar to traditional finance. In your opinion, does this kill the value proposition for smaller players, or does increased liquidity and stability create new opportunities for all of us? Maybe we can start with Jeremy first.
Sure. So, I mean, the people that are going after that part of the market are people like Spark, right? Who are intentionally positioning themselves as, we're not the highest yield, but we're completely safe and we'll give you whatever it is, 4%. And so that doesn't mean that there aren't other frontiers to go and exploit. There's plenty of other things that are out there. So from my perspective, the more liquidity in the system, the better. Now, that's not always entirely true. You can end up with credit bubbles in TradFi and on-chain. But generally speaking, I think we should view the institutionalization as a positive thing, the definition of a risk-free rate, a positive thing. And there's always going to be opportunities to innovate.
Yeah, I say from a protocol perspective, we welcome more liquidity into the ecosystem. And yes, maybe the yield across the board might become more compressed, but yeah, definitely it provides a higher base level of certainty. The liquidity will be probably stickier. It's not going away after a farm closes down. So I agree that there are a lot more that we can do from a protocol perspective. And then the question that we ask ourselves is, like, with new money coming in, how can we best position ourselves to capitalize on the incoming opportunities to better position, say, Pendle or some other protocols, right, to capture the incoming wave. By and large, it's a growing pie, and I think it's largely beneficial.
Yeah, I'd like to say that, DeFi is really the land of innovation. And, just a shout out to Pendle, like that gave us like a massive amount of opportunity and ammunition in terms of strategy design and being able to deploy capital on DeFi. And so like, as more of this institutional capital comes in, as like the, pie continues to grow, you're going to start to see some of these more traditional institutionalized products come on chain. DeFi is most likely going to end up becoming the rail for all yield bearing products and all yield products in general. And you're going to start to see like, these protocols on chain on DeFi start to cater a little bit more towards institutional capital allocators, strategy deployment, et cetera, et cetera. So from my perspective, like liquidity is definitely going to help the ecosystem. It's going to continue to, give opportunities to innovators in DeFi to build cool things. And so, yeah, that's kind of my thought on that as well.
Cool. Our last question is really about where the yield's coming from. So most DeFi yield ultimately comes from trading fees, arbitrage, and speculation, like Chris just mentioned in the first answer, rather than productive economic activity. As the market matures, will sustainable yields require integration with real-world economic activity, or can purely crypto-native yield sources scale indefinitely?
I think it depends on what your definition of utility is. I believe that liquidity is a public good. So I believe there is utility in liquidity, that when you have a more liquid system, you get more economic activity. So I don't view this, I don't view this as like as kind of for lack of a better term, the right question. I'm not quite sure how to phrase it properly, but the evidence is when you have a better financial system, you have a bigger real economy. And so I think that's my answer, that continued DeFi innovation and continued on-chain liquidity are going to help people. And I think maybe part of the challenge is as people in the Western world, I think, are used to having good financial infrastructure, but like Tether has helped hundreds of millions of people, right? Make payments in the real world, send money to their parents, right? I had people on my team that would send money to their parents out of their income every month on Tether, right? Like, so my short answer is a better financial system generates a stronger real world economy.
Yeah, I agree. Not much to add.
Yeah, I definitely agree with that as well. And I mean, from my perspective, like as we progress, into the future of DeFi, what goes on in terms of like bringing traditional institutions on chain as well, like you're not necessarily going to see the crypto native yield versus the traditional yield. It's just going to be yield on chain, built on DeFi rails. And so that's kind of my perspective there.
Cool. With that, I'd like to end the panel and thank you everyone for your attention and all the panelists for their great insight. Thank you.